Hello traders and welcome back to the Forex Geek. In today's video, we will explore the best swing trading indicators that can significantly enhance your trading strategy. So swing trading is a trading method that captures gains in a currency pair over a period of a few days to several weeks. This requires precise tools to identify potential entry and exit points. So these indicators which we will discuss in this video are essential for analyzing market trends, momentum and volatility. So by the end of this video, you will have a comprehensive understanding of 4 powerful indicators that can help you make more informed swing trading decisions. So stay tuned as we will dive into each indicator, explaining its function and how to effectively incorporate it into your swing trading approach. So without wasting your time, let's get started. So the first swing trading indicator on my list is the moving average. So I'm just going to put it on my chart. Moving average. Simple. So moving averages are popular technical analysis tools used by traders to smooth out price action and identify trends. A moving average calculates the average price of an asset over a specific number of periods, such as days or weeks. In this case, it will probably be days and weeks, yes, and not minutes or hours, because we are talking about swing trading. Moving averages help traders identify the direction of the trend. When the price is above a moving average, it indicates a bullish trend. Conversely, when the price is below the moving average, it suggests a bearish trend. So I'm just gonna edit our moving average so that we can observe it better. I'm just gonna use the 20-day moving average. So you can, like I said, when the price is above a moving average, it indicates a bullish trend. Conversely, when the price is below the moving average, it suggests a bearish trend. And you can see that right here. Price is below this moving average, and you can see this bearish trend. This is for swing trading. This happened October 1st, 2024. And you can see after that break of the moving average, price retested the moving average a couple of times and gave us this long-term sells to the downside. You can see this. It lasted well up to for about 10 days before we had this minor correction right here. And price still continued selling for the rest of October. And that's how you can use the moving average. If price is below the moving average, it indicates that, yeah, we are in a bearish trend. You can see it continued for a long time up until November. And when price is above the moving average, like this one, it means that we are in an uptrend and we should be looking for buying signals and buying opportunities in the market. You can see price making higher highs and higher lows, higher highs and higher lows, fake breakouts, and just keep giving us the classic uptrend patterns. So that's one way you can use the moving average. Traders often use the multiple moving averages to gauge the overall trend also. For example, a short-term moving average such as the 20-day crossing above a long-term moving average like the 200-day or the 50-day generates a bullish signal known as a golden cross. And when the short-term moving average crosses below the long-term moving average, it's considered a bearish death cross. So I'm just going to add another simple moving average right here. Just going to take it to 50. You're going to see. Also, I would need this to be red color. Exactly. So this is the 50-day moving average is red in color, while the 20-day is blue in color. So like I said, when the 20-day moves above the 50-day, which is when the short-term moving average crosses above the long-term moving average, it generates a bullish signal known as the golden cross. You can see that happening right here. And after that, you can see this bullish trend after that moving average cross. And this happened in September 12th, and it lasted up till October 1st before we had another signal right here confirming this bearish trend. Delete this. So you can see that, and this is another one. You can see this cross here, and this is another cross suggesting a bullish trend. And that's how you can use the moving average, death cross and golden cross to trade the markets. And it's very good for swing trading. It can help you spot potential trading opportunities in the market. So moving averages can also act as dynamic support and resistance levels, as we've seen. In an uptrend, a rising moving average may provide support while price bouncing off it. In a downtrend, a falling moving average can act as resistance, with the price struggling to break above it. You can see that here already. See, this price uses this short-term moving average as resistance multiple times. You can see it always touching the moving average, using it as resistance until we had this cross. And the same thing is happening here. Price keeps bouncing off it each time, and if it breaks the short-term moving average, it can bounce off the long-term moving average also, just like we have here. So that is how you can use the moving averages in swing trading. So the next indicator on my list is the relative strength index, or the RSI for short. So I'm just going to delete this. I'm just going to delete this moving averages. Okay, now add the RSI. And this is the relative strength index. So let me explain. Relative strength index is a powerful momentum oscillator that measures the speed and change of price movement. It was developed by James Wilder Jr. The RSI has become one of the most popular and versatile indicators in technical analysis. So the RSI oscillates between 0 and 100, providing traders with valuable insights into potential overbought and oversold conditions in the market. So traditionally, RSI readings above 70 indicate potential overbought conditions, while readings below 30 suggest oversold conditions. So let's head into the charts so we can spot that. You can see price here being oversold. You can see this after this massive bearish candle right here. The RSI went to the oversold region, and we could start looking for buying opportunities. You can see this chart pattern just right here, which is the bullish engulfing pattern, which we have discussed in our channel. You can go to our channel when you watch the video and understand it better. You can see the green candle engulfing the red candle totally, confirming that yes, we are indeed oversold and we should be looking for buying opportunities in the market. So we can enter that with stop loss level just below this support level right there, and take profit at the next resistance level. So that's how you can use the RSI to confirm your trades. Never use the RSI alone because it produces lots of false signals, just like this one right here. You can see price was overbought, but the RSI RSI was overbought, but price kept on giving us this consolidation here. Anyway, we are in a bullish trend, so I would not expect less. Always trade in line with the trend. That is the word. So you can see this price frequently hitting the overbought region on the RSI. You can see this price reacting off that and giving us a sell movement to the downside. And that is how you can use the RSI, the traditionally classical readings of the RSI, which is above 70 overbought levels, and we should be looking for bearish opportunities below 30 oversold conditions, and we should be looking for bullish opportunities. So you can see that. So that is how you can use the RSI to trade. That's how you can use the RSI to trade. Another way you can use the RSI to trade is by looking for divergence between the price and RSI. So I'll explain that. RSI divergences occur when price movement doesn't align with the RSI. A bullish divergence forms when the price makes a lower low, but the RSI forms a higher low. So this suggests that the downward movement is waning and a potential reversal may be imminent. Conversely, a bearish divergence occurs when the price makes a higher high, but the RSI forms a lower high, indicating weakening upward momentum. So I'm just going to show you that on the chart. You see here, price is giving us this lower lows, but RSI is giving us lower highs instead. You can see that RSI giving us lower highs here, which is okay, and that signals a bullish divergence, and price could be looking to trade to the upside. And you can see that immediately after that bullish divergence, you can see this movement from here, confirming that. You can see price went to break the structure after that. So this is how you can use divergence in price and RSI to trade the markets. So you can see this is another one. We had this bearish movement right here in price, and you can see this bullish movement in the RSI, and you can see price confirming it with this oversold condition here, like we discussed, and this engulfing pattern here. So you have the price divergence, the RSI and the price diverge, and giving us a bullish divergence. So that's how you can also trade with the RSI. So the next on my list is the Bollinger Bands. I'm just gonna insert that. First, let me delete this. So the next best swing trading indicator is the Bollinger Bands. Let me just add that to the chart. So this is the Bollinger Bands. So the Bollinger Bands was developed by John Bollinger in the 1980s, and it's a versatile technical indicator that provides valuable insights into market volatility and potential trend reversals. So this indicator consists of three lines: a middle band, typically a 20-day moving average. You can see 20-period moving average. You can see this blue line is that simple moving average, and it consists of the upper and lower bands. There are two standard deviations away from the middle band. So that is the Bollinger Band, consists of a middle line, which is a simple moving average, 20-period simple moving average, and the upper and lower bands. So how can we trade with the Bollinger Bands? Well, the first strategy is the Bollinger Bounce. This strategy involves buying when the price touches the lower band and selling when it touches the upper band. It works best in ranging markets. So let's see. Let's check the price chart to see where we can spot that. You can see this price hitting this, lower band and giving us a movement to the upside, and price reacting off this. We are actually in a bullish trend, so looking for more of bullish signals and lower band bounces. See this was a fake breakout. The price just bouncing off the lower band confirms that yes, the bullish trend is going to continue until we had this squeeze, which I'll discuss right now. And you can see price reacting when it touches the upper and lower bands. This can help you into potential opportunities to swing trade in the market. See this one. So always trade in line with the trend. See this, we are in a bullish trend, so price hitting the lower band confirms that yes, we might just see a bullish move, and you can see that. So that's how you can use the Bollinger Bands to trade. And the second strategy is to look for periods of low volatility when the bands narrow, followed by a breakout in either direction. So the initial move outside these bands are often indicated as the direction of the trend. So let's just look for that. You can see the squeeze before this massive breakout to the bearish direction. You can see this squeeze here also. Squeeze, and we have this massive breakout to the downside, and this is another squeeze. You see the Bollinger Band squeeze. We are expecting a massive breakout to the downside. The breakout continued, if we not see this place. So that is it. See this squeeze right here, and you can see this breakout, this massive bullish breakout. So that is it. Yes, this is a perfect example. See this squeeze, and after that squeeze you see the massive breakout to the upside, and you have this squeeze here, and after that squeeze you have this breakout to the downside. So that's how you can use the Bollinger Bands squeeze. Alright, next on my list is the Fibonacci retracement, which is the last we're talking about today. So I'm just going to delete this. Now let's talk about the Fibonacci retracement. So the Fibonacci retracement is a powerful technical analysis tool based on the famous Fibonacci sequence. So these levels help traders identify potential support and resistance areas, making them invaluable for determining entry and exit points in swing trading. So the key Fibonacci retracement levels are 23.6%. Let me just draw the Fibonacci here. So this is the Fibonacci. Key levels are the 23.6%, the 38.2%, the 50%, the 61.8%, and the 78.6%. So these levels are plotted as horizontal lines, as you can see on the chart, connecting a significant high and low point, or swing highs and swing lows. So let me just show you that on the chart. You can see this is an uptrend, and in an uptrend the Fibonacci levels act as support, while in a downtrend they may serve as resistance. So you can see price giving us this high from this swing low to this high, and you can see a retracement to the 50% level before we had the push to the upside. This is another one. We are in an uptrend, so from this swing low to this swing high, and price reacted from the 50% before giving us the push to the upside. So look for, this is another one. Remember, we are in an uptrend, and the Fibonacci levels act as support levels. You see this 50% giving us a support level right here to look for potential buying opportunities to swing. And you can see this for the next couple of days or 2-3 days we were bullish, and you can see from this swing low to this swing high, and price reacted from the 61.8% level, see that right there, and continued the bullish trend. And price broke this swing low right here, and I guess we turned bearish. And you can see price giving us multiple push to the downside. See this swing high right here to this swing low, and price reacted off the 78.6% to give us a push to the downside. This is another one, swing high to swing low. Remember, we are bearish. Price reacted off the 78.6% to give us push to the downside, and this continued for quite a while. You can see that swing highs to swing lows, price reacting off the 61.8%, acting as a resistance level. And this is another one, and price reacted off the 61.8% level to give us a push to the downside. So this continues for quite a long while. You can see this one from that level. If we had to take that from that swing high to this swing low, see price reacting off the 61.8 level to give us this massive push to the downside right here. So that's how you can use the Fibonacci retracement to look for potential support and resistance levels. So deep retracement, especially to the 61.8 level, as you can see right here, can sometimes indicate a potential trend reversal. So when Fibonacci levels align with other technical indicators or chart patterns, they create stronger support or resistance zones. So traders, there you have it. We've come to the end of today's video. Learn to interpret and combine these indicators effectively, and you'll be able to identify potential trade setups and manage risk in your trading. So if you found value in this video, be sure to like and subscribe and turn on the bell notification for more in-depth forex trading content. Your support is greatly appreciated and helps this channel to continue to provide you with the knowledge and insights you need to succeed in the market. Until next time, happy trading.